Congress failed to raise the debt ceiling, so now the Treasury Department is stepping in and raising $126 billion to cover the country's expenses. Let's bring in Joe Teague of Equity Armor Investments. And Joe, will this affect the stock market?
In the short term, no. I think the market is fairly confident that at some point the limit will be raised prior to the Treasury actually running out. The shifting around of the bills, giving Janet Yellen and the Treasury a longer duration, is just something they can do. And I think the market assumes, and I don't know if it's correct or not, but the market's assuming that the debt ceiling will be raised prior to the Treasury actually running out, prior to the U.S. Not having enough money to pay its bills.
What about the S&P 500 trading in record territory this week? Is this index getting too high for its own good?
Is it getting too high? Well, that's a good question. And in hindsight, the answer will be obvious. The markets usually do go higher. Now, we happen to be at a spot where prices or valuations are a lot higher than they normally be. But let's remember the GDP this year is a lot higher than it normally is. We're talking about the debt ceiling. It's the reason there is a debt ceiling is because they limit the government spending. The spending has been through the charts this year and last year, and there's more spending to come. There's $1 trillion, or close to $1 trillion stimulus package. There's still a lot of the COVID relief spending that has not even gone out yet, and they're talking about even more spending passing later this year. So there's a lot of money going into the market. There's a lot of liquidity. And that's why we're seeing these valuations very high. And that's maybe the reason why we haven't seen any pullback off of these high valuations. You usually see that, and we haven't seen that yet.
Thank you for your commentary, Joe.
Thank you for having me.
Go to businessfirstam.com for where to see our show on TV.